Google just saved the stock market. It's a pump fest. Yes, it is. Ladies and gentlemen, round of applause to Google. We will go over Google's results here in this video, what this means for markets, and just how pumpy is it. This is, after all, natural evolution of valuations just don't matter. I've said this before here on the channel, valuations do not matter anymore. You should not invest based on valuations. And I know it sounds crazy, because it is crazy. Valuations just don't matter anymore. That's what Wall Street says. That's what their actions say. So that's what I say. Now, every now and again, are markets going to fall? Are you going to get corrections? Absolutely. But it's not going to be for valuation's sake. The election, the economy, this, Nvidia misses that, God forbid, imagine what that would do. Those are your reasons for corrections. Simply put, if a stock is overvalued, it will stay overvalued until something else derails it. That's what Google's report is showing us. Now, not really to reference Google being overly expensive, because I don't think Google is overly expensive. It's the most attractive looking of the bunch in big tech. But Google's effect on other names are pushing even those valuations higher. Here in after hours, Microsoft is up a handsome 1%, Meta is up 1.5%, Amazon up 1.5%. The only guys that are really losing here are Nvidia, down about 1/4%, and Apple, that's down about 1/2%. The reason Apple is down, what it looks like to me, is just because they don't have much of a relationship with Google's business model. So while Meta, Amazon, and Microsoft, they more so benefit from AI, search engines of AI, data centers, right? Cloud. Apple doesn't have much of that. So it's kind of like this, oh, this wasn't great news for Apple. Let's maybe sell Apple and crowd into these other names. Nvidia is down 1/3% because of AMD's earnings. AMD is currently down about 7%. And even though Nvidia dominates the AI market, AMD not having good earnings also impacts Nvidia. Not as much as it used to, but certainly it still has some impact. So first and foremost, Google was your big dog. This was the most important stock so far in earnings season. And Google's bar was set very low. So Google's earnings were just okay if you consider the bar was lowered dramatically heading into this earnings season. So Google's Q3 2024 earnings, EPS comes in at $2.12 versus $1.84, as was the estimate. Revenue, $88.27 billion versus the estimate of $86.45 billion. Now, here's what I mean by the bar was lowered. If Google had reported 3 weeks ago, they would have missed estimates on revenue. Like, the bar has been very much lowered. Google ad revenue, $65.85 billion versus estimates of $65.5 billion. So that was kind of in line with estimates, slight beat. Google Cloud revenue, $11.35 billion versus estimates of $10.79 billion. That was a bigger beat, $600 million beat or so, about a 7% beat. Again, estimates were lowered, so these numbers look really good, but in actuality, they're some of the slowest growth numbers that Google has put up in a very long time. Operating income comes in at $28.52 billion versus estimates of $26.67 billion, so that came in good. Other bets revenue, $388 million versus $377.9 million. Little, kind of good, doesn't really matter for the story at Google. YouTube ads revenue, $8.92 billion versus estimates of $8.89 billion. So kind of in line there, slight beat though. Revenue excluding TAC came in at $74.55 billion versus estimates of $72.88 billion. So depends how you look at these results. If you look at them from the glass half full or glass half empty approach, you're going to have a varying opinion on these. You know, were they spectacular? No. Not if you consider where estimates were and how low they got heading into the report. It seems like a lot of people were fearful about Google and especially competition coming for Google. But were they good based on the estimates that we had? Yes. So it really depends how you look at this. And it's a so-so. It's a so-so quarter. Is this enough to cause panic in Google? No. Is this enough to cause people to get super excited though? I wouldn't think so. But the animal spirits do run high in markets these days. And I was just listening to the earnings call, the conference call from Google, and it is AI this, AI that. I listened to the call for probably 25 minutes and heard AI like 50 times. So there's definitely a bit of AI pumping going on here. We will see just how markets digest all of that. And I say Google saved the stock market because if Google's earnings would have come in lower than expected, you would be having a rough time right now. You can see just the sympathy moves on your other $2+ trillion stocks. Meta's not quite 2 trillion yet. Is up 1.5%, Amazon up 1.3%, Microsoft up 1%. These are not small moves. Now, AMD's results, no matter which way you want to look at it, definitely were worse than Google. AMD's Q3 2024 earnings adjusted EPS comes in at 92 cents. There was a big beat on, or a big miss on non-adjusted EPS that came in at like 56 cents or so. I can double check those numbers, but that was in line with expectations. Not good enough if, you know, your AMD. Revenue came in at $6.8 billion versus estimates of $6.71 billion. The way that AMD did their guidance last quarter was plus or minus $300 million. So if you consider that, it really wasn't much of a beat on revenue. CapEx $132 million versus estimates of $147.7 million. R&D expenses $1.64 billion versus estimates of $1.618 billion, so that was higher than expected. Adjusted operating margin 25%, estimate was 25.4%, so missed on operating margin. Sees Q4 revenue $7.2 billion to $7.8 billion, estimate $7.55 billion, so guided lower on the low end, a little bit higher on the high end. If you meet in the middle, they estimate what 1.45 or so, 1.5 or 7.5 billion. It was kind of right in line with estimates. Sees Q4 adjusted gross margin about 54%. Estimate was 54.2%, so lower than expected there. So apples to apples, Google's report was better than AMD's, but do they justify how much these stocks have run? Depends who you ask. Am I super excited to buy any of them? No, I think the risk reward is pretty poor. All things said and done, does this power markets higher? Perhaps it could, until we get some more big tech earnings. Tomorrow we're going to get more big tech earnings, and the markets will soon forget about Google's good earnings if Apple or Microsoft or Meta have bad earnings. So it's too early to say the coast is clear for an earnings rally, but this is a good first sign. Now, do I want to buy these big tech names? Absolutely not. Again, the risk reward doesn't make a whole lot of sense, but to each his own. If you like these companies with valuations where they are, be my guest. I think you do have somewhat of a green light. I still am nervous about a potential correction coming in the markets. Do these earnings, are they so good that you have to buy these names, that you're almost forced to buy these names, that the markets will see through everything else? No, I don't think they were like Nvidia's, couple of first quarters where AI started to boom. That's not this kind of earnings that kind of powers through anything else negative that's happening. Let's call it with the election or with the economy that's literally cratering as per the job openings today and the layoff rate that started to dramatically tick up in the last month. Are they that good? No. But can they provide some support until something else happens? Absolutely. One problem that I do see is the sympathy reaction in Microsoft, Amazon, Meta. Now it's placing higher expectations on these companies, and it's going to make it a little bit harder for these companies to do well. Presumably, you will see a move up in analyst expectations for Meta, Amazon, and Microsoft. following these reports from Google. With that said, I just want to emphasize yet again, JOLTS job openings cratered today. The economy is faltering and the markets just don't care. Eventually, the markets will care. This is one of those things that might sneak up on people because the data we got today was pitifully bad. It really supports the Fed at least cutting rates 2 weeks from now on November 7th. It also supports most likely another cut in December. And it does mean the situation is worse than we thought, like a lot worse than we thought. We missed by over 500,000 job openings. That was a huge miss. But markets did not care today, really in anticipation of big tech earnings. Now, for the day tomorrow, as far as economic data, we are going to get the ADP employment changed. You're expecting 115,000 job ads there for the private report. If that comes in higher, that's good. If it comes in lower, that's bad. Pretty straightforward. Markets may be focusing more on the GDP growth rate quarter over quarter. Advanced estimates for Q3 that will be coming out. We are expecting 3.3% GDP. That is right where the Atlanta Fed GDP Now tracker is. So it's not going to be, well, you did see a move down via inventories really from the day today. And, you were just at 3.3% GDP. So most people are expecting a number between 3.3 and 3%. You are now at 2.8% for the Atlanta Fed GDP Now tracker. So a big miss would obviously be bad. But if we have a big gain, something 3% plus, I don't think the markets are necessarily going to react to that either because we all think the economy is growing at over 3%. As far as earnings tomorrow in pre-market, you will get Eli Lilly, Caterpillar, Humana, Global Payments, Trinity, Biogen, Brinker, ADP, Jinko Solar, and Santander. Tomorrow in after hours, you will get Microsoft, Meta, Coinbase, Robinhood, Sonova, Etsy, Riot, Roku, Carvana, and Starbucks. Obviously, with a main focus on Microsoft and Meta. Now, following this 1.5% nearly move higher in after hours for Meta and about 1% move higher in after hours for Microsoft, you have to think the estimates are now higher. And it does mean the odds now of a disappointment coming from either of these two over $1 trillion plus companies, Meta's almost a $2 trillion company now, is a little bit more likely following this report from Google. Is that a certainty? Obviously not, but something we need to be on the lookout for. And then Thursday pre-market, we have Uber, Peloton, Merck, ConocoPhillips, SiriusXM, Altria, MasterCard, Estee Lauder, Kellanova, Norwegian Cruise Line. And then in after hours on Thursday, you have Amazon, Apple, Intel, Atlassian, and some other names. United States Steel is on there, Eldorado Gold, AES, some companies many of you guys don't know about. Friday pre-market, Fubo, Chevron, ExxonMobil, and Wayfair. Mark Newton, head of technical strategy at Fundstrat, says Google beat its, quote, low bar estimate and is gapping up above a confirmed reverse head and shoulders formation. Note the severe pullback into September never violated the larger uptrend from early 2023, and this $74.55 billion versus $72.88 billion Q3 revenue excluding TACB should help short-term momentum start to improve. While breath could prove shaky into election time, this recovery in Mag 7 lately is a welcome sign for the next 1 to 2 weeks and encouraging to see Google come back. So if you ask Mark Newton, this is a great sign for what's to come for markets. And this does raise the bar for the rest of earnings this week, but so far, relatively good. Let me know what you think about all of this down below in the comments section. Let me know if you are looking at buying any of these companies. Again, I don't favor markets on a risk to reward basis. Buying at these levels in this period in time, I'm fully invested in this market though. So if markets go higher, that's great. If markets fall, I'm ready to buy. To the bull's point, to the bull's credit, this report from Google could have been worse, and it's good enough to give the stock some upside and lift some other big tech names, which lifts the market as well. So again, let me know your thoughts down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.